Buying an existing business rather than launching your fresh startup is always been a preferred choice for the most of the investors who doesn't want to go to the hassle of starting up a new company or testing the new ideas, and at the same time they find purchasing an existing business much more convenient and a quick process. In this video, I'm going to chalk out at least 30 points checklist which you must consider before buying any business, so that you can make a very informed decision about your investments and make sure that the business which you are going to buy is the right business opportunity for you and it doesn't end up in a negative performing asset. Hi, my name is Rahil Sheikh and I'm a business consultant and investment migration expert based in the USA. In my firm, Startup Business Bureau, we help foreign investors and entrepreneurs who want to establish or acquire their businesses in the US, and at the same time they wanted to pursue their E2 treaty investor visa or a US business investor visa program, so we provide them the complete consulting and management services. Whenever you are trying to consider in buying or purchasing an existing business, you just need to make sure that you follow the 30 points checklist. This will give you the maximum of idea, and this will give you the whole detailed breakup of the business and the deep insights, like whether the business is worth what it is worth for, or it's the value of the business with the money, the amount, the purchase price of the business which you are determined that worth the business or no, and on the other side the business itself is a good performing business or no. So let's start with the 30 points checklist. And the number one is, of course, identify the business. First, whenever you try to purchase a business, there are certain points which you should consider for identifying a business, which means what is your investment budget, what is your preference location, what is the nature of business, what is the industry which you wanted to start a business. So you need to identify the business based on that criteria. So once you identify that this particular location or this particular business is the right opportunity for you, then you must start considering the next point, which is a verification of the assets. That at the first place you just start, you need to make sure that you verify all the list of the assets of the company, all the furnitures, fixtures, assets, inventories, every single thing whichever is included in that purchase price, even the goodwill, the reputation, the brand image, the whole loyalty of the business, that all you need to verify in terms of the assets of the business. Once the assets is done, you need to verify the inventory and stock. What is the current value of inventory the business currently have? So that will give you a good idea of how much of future operating expenses or the business inventory expenses you can minimize in terms of counting the inventory and stock. Once these are done, then you need to verify the legal documentation, every single piece of paper of the business, right from the business establishment papers, the LLC documents or whatever, the incorporation documents, the registration documents, the tax records, and all the legal papers you need to verify. Even the seller, you need to make sure that the seller is an authorized seller of the business and he actually owns the business, or he has some shares or stakes or authority to deal or discuss the negotiation on behalf of the business. After that, you need to verify the tax records, all the tax returns. Preferred the period for the tax returns is considered at least 3 to 5 years. If it is 5 years, it's more good, but most of the businesses might provide you the 3 years tax records. So you need to make sure that you verify all the tax records, whether every single thing is been clear, is been updated, the business has been reporting the tax accurately, and he's been paying the tax accurately. So all the tax credits and tax returns you need to verify. Number 6, you need to see the financial statements, including the cash flow statement, operating balance statements, balance sheet, all the financial records of the business, is profit and loss statements you need to verify. And again, for this also financial statements, it is always recommended at least 3 to 5 years. 5 years is more ideal, but at least a recent 3 years minimum financial records has to be there. If the business is audited, it's wonderful. That will give you a more detailed and deep insight of the whole financial transactions and the business value. If it is not, consider getting it audited. You can request the seller to get the financials audited. Some sellers cooperate, some don't. So, but you need to make sure that you verify all the financial statements. After that, you need to see all the sales records. That's again a kind of a part of a financial statement, but this will be more in details, in which all the sales records will be mentioned. Next is the purchase records. All of your vendors, your suppliers, your manufacturers, your producers of the products, whatever is going to sell into the business, you need to verify all the purchase records as well. The next point, number 9, should be accounts receivable. That's very important. Most of the people, they don't value that, or they don't consider this while doing the valuation of the business. So you need to make sure that you verify all the accounts receivable, and at the same time accounts payable as well. It's not only the receivables which will add value to the business, but at the same time, if the business has payables, so that will balance out the receivable balances. So you need to make sure the receivables and the payables both are considered properly. Next should be the borrowing and the debts. Any debts disclosure, any borrowings from financial institutes, from privates, from individuals, any kind of a borrowing that the business has, and if the seller has declared that borrowing or no, that is very important to identify, because you don't want any surprises tomorrow. Some of the borrowers come at your door and say, the business owns some liability. So you need to make sure any of the liability statements are provided. Number 12, very important, you need to make sure that you verify any lien records on the businesses. If the business has any lien, any mortgage institutes, from banking institutes, financial institutes, or even the private third-party contractors or anybody, you need to verify from the public records. You need to verify whether the business has any lien on it or no. The next, number 13, should be the returns and the refunds. How is the overall process of whatever the product the business is selling? You need to make sure what is the refund policy, what is the return policies, how many days the business takes the products back, and how many days the business accepts the returns and proceeds with the refunds. And if there is any existing returns or refunds pending in the process, so that also you need to make sure, so that you have a clear picture of it. When the returns comes, then the next item, which normally we don't consider much, again, that is a dead stock inventory. Because if the returns comes, if there are damaged goods, if there are damaged items, and that goes to dead stocks inventory, and that piles up, and that increases the overall burden in terms of warehousing, storage, and recycling. So make sure that you actually count the dead stock inventory. After that, number 15, it should be the customer behavior or pattern. What is the customer behavior to your products, to your business? You need to verify both of the things. Whether the products which business is selling, does that how the customers are perceiving that particular products or services, and how the customers are perceiving the business itself. So business and customers, business and products, both you need to verify the consumer behaviors. We go to the next point, which is advertising cost. That itself is very important. Now, that advertising and marketing costs or expenses, that you need to really identify and make sure that you calculate the cost of customers acquisition, and then so that you can evaluate eventually the profit margins out of the product. So you need to make sure what are the marketing strategies, what are the advertising strategies, what are the advertising campaigns currently ongoing, how many contracts of advertising the business already have signed up, how many companies the contracts are signed up, what is the value of that contract. So that all goes under the advertising cost. The next point should be the price check. You need to make sure whatever the products, if it is single or multiple products or whatever the business is trying to sell, you need to make sure that there is a price check, and the price is as per the market. You should not be overpriced or underpriced from the current market pricing structures. Along when you are comparing the pricings, at the same time you need to do the competitor analysis. What are your biggest competitors in that area and in that industry and in that business, and how these customers or these competitors, how they are behaving, how they are performing into the business, how effective of your business decisions will be for their competitions, or how much of the competitors' decisions may affect your business as well. So you need to verify that in the detailed competitor analysis. The next point should be industry or market history. Now that is also very technical, very important. You need to make sure the business you are buying, it's not a seasonal business, it's not a traditional one. It has to be an ongoing, permanent supply of products and services which the clients have the requirement. So you need to make sure what is the history of that industry and of that market, whether that business is there for a short term period or it has been there, it is existing. So that industry history is very important. The next is the location and the market area, very important for the business. There might be situations where one particular business with the existing owner who is the seller of the business, maybe the business is performing good because that seller belongs to that particular area, or he has his own reputation built up in that area, and you as a new seller, you might not be accepted to for the local community, or you might not find yourself suitable in that community, or even the community itself or the local area or the geographic area is not suitable for the business once you acquire. So that all the calculations you need to really make sure in the location and the market area planning. Next is the business reputation. You need to make sure how is the business reputation in the local surroundings, towards your customers, towards your suppliers, towards your producers, your contractors, or overall business reputation into the market. Is it a negative feedback? Is it positive ones? And that also you need to consider, so that will add up into the goodwill value of the business. The next 22nd is the seller customer ties. How strong and stringent the business ties are with the customers, how loyal are the customers to the business, how loyal are the customers to the products, and at the same time it goes to the vendor ties as well, that vendors or the suppliers of your products, how strong and stringent your ties and contracts with that vendors as well. So that will create a big value or big importance, because you don't want your vendor or a supplier going to your competitor into the market and breaking your ties and going to your competitor and then supplying him the products in a lesser price or a more quality or whatever the case might be. So make sure how strong your ties is. Better to review the contracts as well if they have it. The next 24th point is the salaries and the pay records of the payroll records of the employees. You need to make sure that every employee has been paid on time. There is no backlog on the salaries. There is no reports or the negative marks on the business in terms of when it comes to the wages and salaries. At the same time, 25th point, you need to see the number of employees, the hierarchies, organizational chart of the business. If you can go deeper and find out the previous employees' files as well, it is wonderful, because then you can eventually see what is the length of their stay in the organization, what is the reason of their leaving, because most of the times when employees are leaving, they might put some negative remarks of the business if there is any. So you can that will give you a good feedback in finding the overall business structure. Next is again the business reviews and the feedback, which is related to the business reputation, but you need to see on the local social media or there are the Yelp site or the social sites or any classifieds, even the recruitment sites. You need to see the whole business reviews, how many reviews are there, what are the number of reviews, what is the value of reviews. So you need to verify all of them. The next point should be insurance. You need to make sure the business has been protected from the insurances, the general liability insurance, employee insurance, or all the other relevant business insurances are there and up to date, and there is no backlog in the insurance. And at the same time, don't forget to verify from the insurance companies whether there have been any insurance claims processed from the businesses recently. So that also will give you a good overview of the business. The next point, return on investment. When you do all these calculations, you need to make sure that the business value, whatever the seller is demanding, you can calculate the return on investments, and you are make sure that you're going to make the profit out of it. Last two important points, very important, the marginality of the business, which is correlated to the return of investment. Like what is the marginality, what is the profit margin, what is the gross margin, what is the net margin on the business. So you need to make sure what is the overall marginality of the business. You can consider this as a marginality or the margin ratio per client or per employees or per product. So there are different calculations, there are different ways which might help you to determine the overall marginality ratios. Last point, scalability. You have done the return on investment calculation and you find out that the business fits into your requirements and it is marginal. It is giving you the required profit margins and it is giving you the required return on investments. But is the business still scalable? You need to make sure that there is a scalability element into the business. What does the scalability means? Like today, whatever the X amount or X dollars you are investing on the business, maybe you get a return on it, but what about the scalability? What is the potential that the business has? Like tomorrow, if you want to duplicate the existing business model or this whole structure, how easy and convenient is that? What are the entry barriers? What kind of cost or investment barriers you might face? So that all is considered under the scalability. So that is also very important for your business point of view also, and as well as if you're planning to qualify for a US business investor visa program. So that is one of the most important factor as well, that the business has to be scalable. The next should be after all this, then you will determine the business valuation. How much is with all these factors into the consideration, then you would be in a better position to identify whether the business, what is the valuation or the current demand of the business. Is that making it worth of investment or no? One important point, it doesn't impact on the overall value of the business, but it gives you a very good feedback onto the price or demand or the overall process flow, whether there is a seller directly selling the business or there is a seller broker involved into the process of selling it. Because if there is a seller broker involved, it has its own pros and cons. So you just need to make sure that the person whom you are dealing with on behalf of the business, that is the right person, and he is a seller broker or he is a seller himself. And considering all that information, you might take a call and decide whether do you need a buyer broker as well or no. If you are familiar with going to all of these processes, then wonderful, then you can spend your time. It's very time taking process, so you need to make sure, but you still spend the time because that will value your overall investment dollars. But if you don't have a time or you are not familiar with that whole processes or how to identify and verify all these informations, then it's always recommended to go for a buyer's broker as well, because the buyer broker will be the best person to negotiate if there is a seller broker involved in the deal. So because the broker and broker will, they will be in a better position to communicate and even negotiate the price as well for the business. I just hope that this whole process will give you a sufficient information and a piece of knowledge to identify a right business opportunity and to make a valuation of the business in the right figures, and you would be in a better position to take a more informed decision about the business. If you still have any questions, if you still have any queries or concerns with regards to identifying a business or finding a business opportunity or valuing the business or doing this whole process or even processing the business after the business acquisition, processing the business investor visa for the US programs, feel free to give me a call. My numbers are there in the description of this video. My website, my email addresses, all information is provided. Feel free to contact us or raise your concerns and questions. I'd be happy to answer you. Thank you so much. Goodbye.